Hello and welcome to another episode of Nothing Ventured with me, Aarish Shah. Today in the studio with me, I have Enis Hulli. Enis is a general partner at E2VC, an early stage venture fund backing the best founders from emerging Europe and helping them scale globally through a deep network and strong Bay Area presence. Originally launched as part of the 500 Global Network, Enis led 500 Emerging Europe's Fund 1 and Fund 2 before rebranding to E2VC to reflect a more focused and independent strategy. E2VC is doubling down on a thesis rooted in price discipline, concentrated portfolios, and high conviction support, writing $1 to $2 million checks and embedding into the journey from pre-seed onwards. While E2VC's roots lie in Central and Eastern Europe, Poland, Ukraine, Lithuania, Turkey, its mindset is firmly global, with Enis and E2 focused on backing technically ambitious operators, navigating blue ocean markets, and ensuring capital is a catalyst, not a crutch, in the search for product market fit. In today's episode, we talk about how 500 Startups was a great partner as a young first-time fund manager, but things have moved on.
I had no idea about how venture capital works, all the back office stuff, the legal parts, let alone having a brand, such a brand that would, you can represent, that would enable you to do the fundraising. It was really helpful.
How opening up the top of the funnel to map talent is even more important early in the journey.
To be able to build that conviction early on, you obviously need to have the network, the relationship, the talent aspect with it as well.
How emerging Europe builds US native unicorns, and why you can't build a unicorn if you're remote first, especially out of emerging Europe.
All your job as a founder is to make sure that you're iterating fast enough on anything, on the product, solution, customer segment, go to market, whatever you're iterating on, iterate as much and as long as possible to be able to find that rain. But make sure that when it rains, it pours, so the growth is not that linear.
How emerging Europe has fundamental expertise in gaming, but also in deep tech and infrastructure, and how when product market fit comes, it really hits hard.
Remote first, you can still be living in Poland, but build a billion-dollar company that generates revenue globally. I think that has shifted completely.
How the team can get you from 0 to 1, and how VC is a trust-based business.
Trust needs to be more than 8 out of 10. And then even if your track record is 5 out of 10, you're good. People would give their money to you because it's hard-earned cash that they're giving to you for 10 years, 12 years, maybe 15 years, for God knows.
When you're raising from LPs, you cannot get away from building relationships. Let's get straight into it. Hey guys, whilst I've got you here for a second, I thought I'd reintroduce myself. My name's Aarish. I'm the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you enjoy the podcast, we'd really appreciate it if you could subscribe, like, comment, and give us a review wherever it is you listen. And of course, if you want to discuss anything with me, whether that's a new guest that you would like to hear from on the pod or anything else, do drop me a note on LinkedIn or Twitter. I'm always up for a conversation. Right, let's get back to it. And it's great to have you back in the studio with me. Really excited to be doing this again under a new kind of a new umbrella, new structure. Really wonderful to have you.
Well, excited to be here.
Amazing. Well, look, let's get straight into it, right? As we talked about in the quickfire, you were previously operating under the 500 Global umbrella. So can you talk me through the decision to rebrand to E2VC? And it's really more than just a rebrand. What changed, what stayed the same, and has that move away from 500, do you think, helped or hindered when it comes to either founder perception, LP conversations, or even just your kind of general positioning in the market?
Well, as a first-time fund manager, I think 500 Startups has helped me a lot. Going back to 2015, and I was only 24 years old back then. First-time fund manager, I had no idea about how venture capital works, all the back office stuff, the legal parts, let alone having a brand, such a brand that would, you can represent, that would enable you to do the fundraising. It was really helpful. All in all, our partnership was that as the GP, you would do the fundraising, you would also do the deal making and the portfolio management, but you would obviously leverage the brand, the network, and the back office that comes with it. But as you mature as an organization and as a general partner of a fund, obviously you get to know all of these and how these things would be done. And I think we've transitioned away from the standard 500 Startups structure or the Thesis. So initially, Fund 1 was a $10 million fund writing 100K checks. But then the second fund was 75 million, much larger, and the average check size went from 100K to 750K, with follow-ons up to 2 to 3 million, and a much more concentrated portfolio. If you look at 500 Startups' investments in different emerging markets like Middle East or Southeast Asia, you would see that they invest into a lot of companies, smaller checks on pre-seed. Whereas with our thesis being solely focused on the US market, you have to make sure that the founders that you back are like 0.01% out there, because they have to compete in the US.
And with the capital to
Exactly. And with enough capital to, be able to go there and raise a proper seed. Hence, I think our strategy was a bit conflicting with the model. 500 Startups is very well known as an accelerator, which is not what we are. So every time we meet a founder, we're trying to climb that uphill battle as to telling them, oh no, we're not just writing a couple 100K checks. Oh no, we're not an accelerator. So all in all, I think this transition from 500 Emerging Europe to E2VC has helped us on the deal flow side for sure. And then in terms of operations, we were already operating independently. So our back office was separate, our GP entity was separate. The team was, we have a 10 people team. The team was managing everything end to end anyway. So all of that stayed the same practically.
Yeah. And I guess at a personal level, right? Like for you, was there a little bit of an emotional lift in being able to kind of just take the fund on as yourself? Like you're no longer quote unquote reporting to another entity. You have the freedom of execution, or freedom to execute how you want to execute, et cetera, et cetera. Like how much has that liberated you?
It has liberated me 100%. It's not the reporting per se, because there wasn't that much reporting. It was the brand control and the new initiatives.
Yeah.
So the brand control, the brand that we're trying to build in emerging Europe, in Baltics, Eastern Europe, and Turkey, is being this very high conviction, high ticket size fund that would come on pre-seed and then push you to go to the US. But then when there are multiple, if not a dozen other funds within the same brand that have different strategies, that creates conflicts, and you can't find that. It's just too much of an inertia for there to fight. So it's the brand control. And the second element is all these initiatives. We're launching a very large San Francisco office, which could have been possible under 500 as well, but there would be more friction and more bureaucracies involved. And going forward, we want to be able to I really don't like the fact that venture capital is a very rigid asset class. So I want to make it as elastic or as flexible as possible, which means more SPVs, more different types of vehicles. Like
one of the things you talked about just before we started recording was this initiative of writing like 5 to 10K, like presumably grant checks into like high school students. I think that's amazing, right? Like it's one of the things I've talked, with Alex McDonald, who you may well know.
Oh yeah.
At Sequel, ex co-founder of Velocity Black. We at one point were thinking about setting up a foundation, essentially to do something similar, right? Like how do you get checks into the hands of the people that have never considered entrepreneurship or never considered venture as something that was approachable, people who didn't have did not have the security to even be able to take the risk, but also may have been young, may have been ambitious, but didn't know where to go. And actually just, 5 or 10 or 15K, whatever the number is, check gives them the ability to go out there and explore. I just think that's just an incredible initiative.
Like what pushed us to doing that was we did a lot of talent mapping. Our whole thesis was to meet with top talent early on. So any Turkish engineer who's working at a Databricks or Snowflake, we have to know about him or her for sure. Because 2 years, 3 years, 5 years down the line, he or she becomes an entrepreneur. And then we have to build that relationship early on. So half of our deal sourcing was actually talent sourcing, which then fizzled down to colleges and universities. And we're like, then we have to know every single Turkish or Eastern European person in these elite colleges in the UK or the US, because they become founders. But with AI, I think that's gone even earlier than that, where we're seeing a lot of high school students, they're 16, 17 years old. They would be building companies. They would start at college, and then first year they'll drop out. And it's happening maybe 10x more than what it used to. And that 5K grant that you give to them when they're 16 goes a longer way than that 1 million commitment that's going to come 4 years from now.
Yeah, I mean, there's someone else we've interviewed on the podcast, a guy called Manish Karani. He's building a company called Eureta AI, where what he's been able to do through a bunch of research and work with UCL and I think Cambridge, forgive me if that's wrong, but they've been able to map the traits of entrepreneurship, which means that he can, like, using their tech, they could go and interview, let's say, what would be like a classical job for for a mother in Turkey? Like what would be a classic kind of just normal blue collar type job?
Blue collar type job would be textile.
Okay, so textile, right? So
Yeah.
so someone in the textile industry, they could literally get that woman to go through their to go through their kind of Q&A, I guess. And then map those entrepreneurial traits back onto the traits that they see in entrepreneurs. What does that mean? What it means in reality is, okay, not saying that this woman who's in the textile industry would ever be an entrepreneur or has ever considered being an entrepreneur, but if you are able to identify that actually she could be an entrepreneur, that then becomes a target to potentially develop and influence and so on and so forth. And of course, you can do that with students. You can do that with, with people outside of the traditional workforce. You can do that with anyone essentially, right? And it just gives you a better edge as to figuring out who has, because we all know, right, that it is grit, it is tenacity, it is often overcoming hardship, it is all of these things that often differentiate the absolute best entrepreneur from like an average one, right?
And I think the reason why a lot of the other funds are not doing this is a lot of the funds look at this business as more of a cyclical business. Like they would be planning for 3-4 years max because that's their deployment pace, and then they have to fundraise again.
Yeah.
But becoming a venture capitalist while I was 25 years old and now I'm 34, and assuming that hopefully I'll be a venture capitalist for decades to come, I'm trying to think more in 30 or 40 year
long-term
horizons.
cycles, yeah.
And then doing that, giving that grant to that 16, 17-year-old high schooler, that couple K grant to a bunch of them, has a very much of a compounding effect. If you do that for 5 to 10 years, from a branding and an emotional standpoint, you would be unbeatable in the market.
Well, you become the first port of call, right? When they go out and launch their first business, like they're going to come to Enis and say, look, hey.
And multiple generations would become that for, years to come. This is a very generational business.
Well, not only that, right? But actually, word of mouth, as we know, is like reputational branding is so important within, I would argue, in everything, but certainly within venture. And, that 16-year-old, when he is 24 or she is 25 or whatever the age is, whether they are building their own business and trying to raise capital at that time or not, they're almost certainly going to have a friend who might be, right? And
Exactly.
and that just makes you more visible than someone else who's just taking, the decks from the Harvard grads or whoever it is, right?
And I think Malcolm Gladwell put this really well in his book, The Tipping Point, where there are the mavens, there are the sellers, and there are the connectors. These people that we would identify in high schools, the top students who want to become founders, that we give the grants to, 100% is going to be one of the three, and their first circles are going to be the other three.
Yeah.
So we're for sure going to tap in both the mavens, the sellers, and the connectors throughout different generations with this.
Yeah, I mean, it's a self-compounding and self-fulfilling kind of cycle, which is amazing. So look, you've always been bullish on emerging Europe, and it's very clear just listening to you talk. I remember now our first conversation. But what has changed across the region in the last 5 years? Right, we recorded I think 2 or 3 years ago, but over the last 5 years, what are you seeing that's changed? And obviously, there's been quite significant geopolitical shifts, right, as well. Where are you seeing the most exciting activity at the moment, and what markets do you feel that you have won where E2VC has like real edge, and where do you think you're not quite there yet? And you've told me that emerging Europe is starting to feel more consolidated. So can you explain what you mean by that, and maybe start off by telling us in your words what emerging Europe even is?
So emerging Europe for us from a regional standpoint is the Baltics, Eastern Europe, and Turkey. And what makes this region unique is if you look at the unicorns coming out of this region, these would be very US native companies.
Yeah.
If you look at unicorns in Southeast Asia, the Middle East, Latin America, they would be very hyper-local or regional businesses.
Yeah.
Well, not the case in emerging Europe. So that's how we define the region. It's almost like executing the Israeli strategy, but not just in one country, across 20 countries. And the upside of executing that strategy is huge, because this is a very US native game. If you look at the venture returns, you would see that a lot of the decacorns are US born. There's only a handful in Europe, and the rest of the world, maybe there's not even a handful of decacorns. And venture capital doesn't make sense if you don't have the decacorns.
Just on that point, I think I mentioned earlier about, we had Joe Knowles on. He threw out this stat that blew my mind, right? So as I said, over the last 15 years, 15,000 startups receive venture capital funding in Europe. Of the 600 billion odd euros of realized value, 40% of that came from 130 companies
alone.
I mean, it's
The power law is everywhere.
Yeah.
I was looking into the unicorns of 2021, and then even power law exists in the unicorn world. Half of them died, but then a couple of them became $50 billion plus, and that makes the whole asset class worth it.
Yeah.
I feel like this power law is there on pre-seed as much as even after the unicorn mark these days.
Yeah.
Which is crazy.
Yeah.
But going back to your question around emerging Europe, so
Yeah.
that's how we defined emerging Europe and our thesis around it. When you compare how it was 4 or 5 years ago, I feel like there was two paradigms that kind of changed. Paradigm one was in some large enough markets like Poland or Romania, you still had some hyperlocal companies. You still have had some companies that wanted to grow in Poland and then expand into Europe. I think that has faded away in a good way, where we're now seeing Polish founders to be much more globally or US focused, similar to founders from Croatia or Hungary, because these were much smaller markets. So these founders from these countries like Lithuania, like Estonia, had a global outlook. So that was paradigm shift number one. Paradigm shift number two is, I think there was the notion, especially after COVID, that you can build a large enough business even by having your HQ and you being physically located in a place like Zagreb, Budapest, or Warsaw.
Remote first or whatever.
Remote first, you can still be living in Poland, but build a billion-dollar company that generates revenue globally. I think that has shifted completely.
Yeah.
SF San Francisco was losing beginning of COVID, but then it made a resurrection, I would say. And I think that's due to the talent network. With AI, 10x engineers became much more important. And 10x engineers becoming much more important meant that the talent network effect became much more critical. And
proximity became really key, right?
Key, and then you have to be either in SF, New York, London, Cambridge, Oxford, sure, Zurich is doing a good job as well, but like there are certain number of finite hubs. You cannot just build a unicorn from anywhere, which used to be the norm, I would say 3-4 years ago. So now I'm seeing more founders from emerging Europe who want to move to the US, not to the US, even to the Bay Area from day one.
I think one of the things that's super interesting in what you just said, right? So I think there's very clearly, I can see, you've got the things like 996 and like all of these sort of like work yourself to death kind of mentality, which, we can argue how much of that is valid, not valid or whatever. But I think the one thing that definitely is very clear, if you're trying to build a generational business, you have to be in close proximity to A, where the capital is, but B, where the talent is, right? Like, and it is impossible to really try and build a consequential business if you are doing it fully remotely. You can build a good business, don't get me wrong. You can build a great business even, but you're not going to build the next Uber. You're not going to build the next unicorn by doing it remotely. And especially, I would argue also, like, the minute you slap emerging onto anything, right? Like the immediate reaction is, okay, so it is still not yet, right? Somewhere, right? So it is lacking in something. There is something that is still yet to emerge in that market, right? And maybe it is middle class or spend, or maybe it is talent, or maybe it is capital, or whatever, right? So what that tells you is that if you remain remote first, building out of emerging Europe, something is going to be missing from the mix, which means you have to go to where that missing element is. Otherwise, you're just not going to make it.
100%. I think you have to know your strengths and leverage them, which is technical talent, getting access to that top tier talent retention, the cost of talent. And when those three combine, that enables you to go for more blue ocean markets and stay in that market until the right timing comes. And when the right timing comes, you've been there for a while, so you seize that opportunity. All of the talent aspect enables you to play that game. But then there are also the weaknesses of the region. And I think that 10x engineering talent is part of it, but then capital resource is a huge part of it as well. Your main goal, your job as the founder is to make sure that company can die for a lot of reasons, but it shouldn't die because of capital constraints. And that's your job number one, and then everything falls underneath it. So I totally agree with you. And then with emerging Europe, I think emerging has bad connotations. Obviously, it does. But at the same time, a lot of the founders, I feel like the founders that want to up their game every single time are the ones where they put themselves into different circles where they always feel inferior. They raise a Series B, but then they feel tiny. They're like, oh, there are all these unicorns. I'm just a Series B company. Then they become a unicorn. Then they're like, oh, we're just a unicorn. Half of the unicorns die. Look at all these public companies. How are we going to become public? Then they become public, and then they're like, oh, we're just a $6 billion company. Our competitors, let's say in the pharma world, because my example is coming from that side, are like
100
decades,
billion
100
plus, yeah.
plus like 100 years old companies that are, tens of billions of dollars valuation. How are we going to win against them? So in their mind, they're always emerging. They always put themselves into certain buckets where they're inferior, so they have to fight up. The moment you don't put yourself in such a bucket in your mind, might make you happier, but you would feel superior. It's good for your ego, but at the same time, it would hinder your growth.
Yeah. So it's that, like, I would describe it as kind of the migrant hustle, right? Like or the migrant mindset. When you come to a new country, you are constantly proving yourself again and again and again, and trying to get yourself to a place where, not necessarily the way you're accepted, right? Acceptance is a very fragile word, I think, but where you can feel like, okay, I have done justice to whatever it is that I set out to do, right? But equally, like, I think, there's a couple of things I was going to say. One is that chip on the shoulder, and am I good enough yet? Like, part of that is also moving to somewhere like the US and the Bay Area, because then you are rubbing shoulders with those people who have either IPO or have raised the Series C and are at multiple unicorn status, or have IPO'd, or have moved off their own cap table or moved out of their own business or whatever, right? And you're just going to have more people from whom you can draw lessons from, right? Whereas even if you're in the UK, forget even emerging Europe, but even if you're in the UK, the density of, or the number of people that have been through that process, who've understood it, who've really kind of figured it out, is just minimal, right? Like, it's just a very tiny number of people. And the other thing that came to mind, I was sort of chuckling to myself, is we've spoken to a number of businesses from various places in, I would say, Eastern Europe for the most part. And one of the massive gaps is, like, on the finance side, is CFOs, right? Because often no one has been through that process. So you get a lot of accountants, but they're not CFOs. And then people give us a call and they're like, hold on, why? Like, we're being told by this incoming investor that our CFO is not good enough. And I'm like, well, what do the CFO do? Well, they manage the books and they're handling the accounting and making sure that, that we file our stuff. And I'm like, well, that's why they're not good enough, right? And that's why moving somewhere like the US or the UK, even for that matter, or even Germany or wherever, you start having to see how, quote unquote, grown up businesses operate, and you take that on board, and then you start doing the same things yourself. And I guess the final kind of question there is, like, and you've already described a number of the edges that you feel that you have, but what is the one edge? Like, is it the E2VC? Is it the presence? Is it the talent mapping? Is it the fact that there's probably, I would imagine, €100 million fund is pretty big for the region? Like, what is the edge that you think you guys bring?
I think as a fund, it's very tough to find an edge, because you find an edge, you lose it. You find an edge, you lose it, or it compounds over time. Right now, for us, it's high conviction.
Yeah.
And then how can you have high conviction? It obviously goes down to the fact that you anchor yourself to talent. So you know these people early on, relationships. You know how they can work with you, or you know how you can work with them beforehand. That's why we're going all the way to high schools to map top tier talent. And then being able to write that first check on pre-seed, even after doing a call. But I would put all of that under the conviction umbrella. But then to be able to build that conviction early on, you obviously need to have the network, the relationship, the talent aspect with it as well. And that's why we also have a full-time talent team, by the way. We have a 3-people talent team back at home that's only mapping 10x engineers, both because they can become founders, but also to place them into companies. But all of those are more side benefits.
Yeah, sure. I mean, look, I think I'd agree. Everyone is constantly evolving their proposition, right? Like, you spend lots of time on your vision, on your mission, on all of these sort of things, on your thesis, right? And that evolves over time. Like 3 years ago, 4 years ago, 5 years ago, the people with an AI thesis were few and far between. Like, and they were, people knew who they were, but they were like ML ops, like that's what they were doing. And now everyone has an AI thesis, right? And then you got to figure out what your edge is.
And I think with them, like 99% of the value that the VC would bring, the VC would actually bring by doing nothing. It's a signaling value. It's the fact that you've backed a founder,
Yeah.
So all the legwork that you do, it's, us backing 4 unicorns, us having 100 million fund. Us trying to push forward the brand and the founders that goes with it is that 99%, so that they would want to get an investment from us, because they would know the signaling that comes with us writing that first check.
Yeah, I mean, signal, relationships, reputation, those are the things. And like being able to help founders through those tougher decisions. Like, when do you move? Well, like, okay, who do you hire? Who do you fire? Is this the right CTO? Is this the right CMO, CFO, whoever it is, head of commercial? And if things get really tough, okay, how do we find an exit that isn't necessarily a soft landing, but one that does right by you, your team, and hopefully also the investors, right? So all of these things are important.
Yeah, a lot of these guidance we also get from our LPs, because we have 35 founders that back the fund.
Amazing.
A couple of them are decacorns, more than a dozen are actually unicorns, half of them already exited. So there's a lot of, in different industries and geographies, there's a lot of expertise we can tap into. And we want the LPs to engage with our portfolio founders a lot.
Shifting tack a little bit, right? And we kind of touched on a little bit of this already, but you've backed a couple of Ukrainian founders already, right? But Fund 3 sounds like it's going to go even deeper into that ecosystem. Why now? And I guess that's maybe an obvious question, but I think it is a relevant one, right? Because one would hope it is not. I mean, one would hope, yes, it is to support Ukraine through what is happening on the ground there today, but also one has to think about how transient that is and how long term that strategy can work. And what's your framework for investing into a region that is still in conflict? And what are you seeing coming out of markets like Poland, Lithuania, Estonia? Are you starting to see sort of thematic depth? You talked about how you are very much replicating the Israeli thesis across 20 countries, and I would argue the Israeli thesis, apart from their thesis about building consequential companies that can be taken out to the US, a lot of Israeli businesses are very technical, kind of cutting edge, bleeding edge type businesses. Are you seeing something similar, or is it more consumer focused? Like, what is the kind of core theme in the region, do you think, if there is one?
So our thesis for the fund has been we're anchoring ourselves to the technical talent here, which is similar to what you said around Israel, but then also mobile gaming in Turkey, which is funnily enough similar to Israel, because I think in mobile gaming it's Israel, Turkey, Vietnam, Finland, one of the 4 countries that are thriving these days. So consumer, we do a lot in mobile gaming. I would say 20% of the fund is mobile gaming in Turkey, but if you carve that out, the other 80% would be deep tech, dev tools, AI, ML, infrastructure, so very technically deep founders. And Ukraine was our starting point in Eastern Europe. So my first visit to Eastern Europe from a business standpoint was actually to Ukraine. And then I traveled around Kiev, Odessa, Lviv, and then I did that trip a couple of times. In Fund 1, we did 4 investments in Ukraine. Starting off Fund 2, we thought
4 of your 10 mil. So, okay.
Out of 40 investments, 4 of them were in Ukraine. Starting off Fund 2, I thought that would continue, but obviously then the war happened. But with Fund 3, we want to double down and do Ukraine again, because as I've traveled into different cities in Ukraine, I realized that a lot of the founders' technical talent is across like all the cities in Ukraine.
Yeah.
And then they all want to build for outside. Even though it's not that small of a country, that mentality has been there for a while, I would say for the past 20, 30 years, because of the stance of the economy not being that great. And then that enables you to create very large businesses like Grammarly, like GitLab would be good examples of that. So we would definitely do Ukraine. And how this current both political and issues and the war is affecting, I think wouldn't have much of an effect, because again we're comparing it to Israel. Israel has a war every 5 years, and I'm not talking about what's happening today.
Sure.
In the country, so I'm not that much concerned about that from an investment thesis standpoint. And the region, as I've said, like I think Poland, Estonia, these countries, Romania, also had some entrepreneurs that were more pan-European, so they would execute either tech-enabled services businesses or more B2B SaaS businesses that are solely focused in Europe. Now we're seeing that much less and less. So our thesis into doing deeper products with a US first approach in more blue ocean markets where you actually want early adapters with high budgets, and then early adapters, high budgets, again, unfortunately, is only available in the US, is now widespread across the region.
I mean, and I think this is the whole point about an emerging economy, right? Is that you have very green shoots that, it is still a frontier, which means if you get in today, your uplift is going to be much more significant than, okay, those that are waiting. And I say this a lot about Africa, for example, right? People investing in Africa. Some fund, like I remember some fund, this is a couple of years ago now, I can't even remember who it was, but some fund said, yeah, we're deploying actively into Africa. We're looking for businesses. This was supposedly a VC fund looking for businesses with, 2 million EBITDA. And I'm like, okay, well, no, that's just not going to happen. Right. But what it sounds like is, again, you've got that confluence of tech, of talent, of capital, of of expertise, right? And that's just an exciting place to deploy, right? Like, and I guess the other thing, and we'll talk about this a little bit in terms of LPs, but the other thing is you're not fighting against the other, however many, I think there's 1,000 plus whatever VCs in, say, the UK, trying to find the next great founder that's in the London or the Edinburgh ecosystem, whatever.
Yeah, I think what's great about our thesis is VC is very cyclical. Emerging market in general is even more cyclical. So if you're trying to make returns in an emerging market like Africa, like Turkey, it really depends when you bought and when you sold.
Yeah, true.
It's very tough to catch that macro trend because of how cyclical it is. But then with our investment thesis, companies are generating revenue from the US. So out of the $1 billion plus revenue that's being generated across our portfolio today, I would say 80% plus is from the US. So although emerging markets are cyclical, our thesis is not. We are getting the cyclicality of venture capital as an asset class, but that's fine. But I think even that has a cushion on it. And why I'm saying that is because on good days, our companies are raising well. On bad days, the fact that the talent is back at home actually creates almost like an anti-fragility where a lot of these US peers that we're going head to head with, some of them have raised much more than what we did, would actually collapse because they can't sustain the burn that they've created. In the meantime, we can, weather those bad days out and then be the only company standing. Firefly, our portfolio company that does out-of-home advertising, was an amazing example of that. So they do digital out-of-home advertising. It's a taxi top company. If the taxi goes into an airport, it would show Turkish Airlines, for example, right? And after COVID, all these companies went bankrupt. Uber closed this division, Lyft had a division, they closed that division as well. But then because the cost base of our company was in Turkey, they endured. And then they started buying all of these companies, both on the supply side and on the demand side, getting them to close to $100 million in revenue. So I think there's that anti-fragility that even breaks the cyclicality of VC.
Yeah, because you're able to weather the storms, exactly as you say. And I mean, again, it is one of the benefits of operating in some of these jurisdictions, because you can stretch your capital further, which comes actually quite nicely onto my next question, which is, something that stood out to me. You're writing $1 to $2 million checks at pre-seed and at seed, which really isn't typical for most funds in your geography, right? And, even under the 500 umbrella, you were, initially only deploying 100 and then 750,000 checks, right? So why have you gone up to that 1 to 2 million mark? And on that point, you've talked about like price elasticity and how capital shouldn't be a constraint when a business is looking for product market fit. So can you unpack that a little? Because I have probably a slightly more CFO-y kind of response to that. But yeah, I'd love to kind of understand those 2 points. Why the 1 to 2 million at pre-seed, and then how do you think about that capital efficiency?
So I think for the founders in our region where we're doing their pre-seed, for a lot of them, $1 million check would be enough. $1 million check would actually enable them to move to the US and raise a proper seed round with our backing. So we want the company to raise another 3 to 5 million in the next 12 to 18 months. Again, with us pouring more capital in, and 1 million would suffice that. But for founders who are already based in the US, obviously they're out from the outset, they're trying to raise that 3 to 4 million round. So our million becomes a very small ticket. And we realized that in Fund 2, we've actually lost some deals because our ticket size wasn't big enough.
Interesting.
If you were to give them a proper term sheet where we're a lead investor, we could have signed that term sheet in, 2-3 days and then gotten that deal. So going from 750K average to that million average, it's not because we're trying to uplift the whole average. It's more like we're trying to do some outlier deals where the entry ticket is going to be 2 to 3 million as opposed to that.
Which is very much the case, as you're saying. I mean, like we talk about, a pre-seed round in the UK is like $500,000 to $1 million max, right? Sterling. Seed is often $5 million, right? $5 million is a pre-seed round in the US. Like,
Exactly.
I mean, no one's getting out of bed for less than that, right? Like it's, and I think this is the other thing. Like our expectation of founders, rightly or wrong, like, so we still have this mentality, I think, in Europe where, you know, you got to do it hard, right? We want to make it tough because we want to see whether you can actually, you know, whether you can actually deliver. In the US, it's like, no, take the capital, because if we have high enough conviction in you, we know that you will deliver, even if it takes you a bit longer and you have to burn through a bit more of that capital.
Exactly. I think the mentality in the US, and especially also coming from Y Combinator and the culture that it built in the Bay Area, is that when product market fit comes, it comes. When it rains, it pours. And then all your job as a founder is to make sure that you're iterating fast enough on anything, on the product, solution, customer segment, go to market, whatever you're iterating on, iterate as much and as long as possible to be able to find that rain. But make sure that when it rains, it pours. So the growth is not that linear. Whereas in Europe, we see a lot of companies where they never find product market fit. They sometimes get to 5-10 million ARR without finding product market fit. It's too much of a brute force effort of pushing your product.
They're just adding logos as opposed to finding.
Exactly. Which is good. You're building a company, but from a venture output standpoint, it would never create that unicorn that you wanted to create. You know, for that you need to make sure that it's almost you're sailing and you're looking for the wind, and make sure that you find the wind. Don't just be okay with, you know, very small wind that gets you going but doesn't get you that far. So from that standpoint, I feel like the main job of the founder is to make sure that they have unlimited runway, unlimited iterations, while on their way to trying to find where the rain is. And they might be iterating everything in the business. When you have enough cash, and you know that your runway is unlimited, 5 years, 10 years, doesn't matter. So it's a very lean team with a lot of cash to experiment and have unlimited runway, then you know that those founders are looking for something big.
So then what are you underwriting there? Are you underwriting the team? Are you underwriting, because like, obviously if the expectation is, not the expectation, if the assumption is it's going to take some time to get to product market fit, and you want to get to the right type of product market fit, let's put it that way, or the right type of kind of revenue profile, right, of customers, then what that suggests is you are underwriting the team, right? Like, you're not really underwriting the idea. You're underwriting the space.
We're always underwriting the team. I think our decision making is solely focused on the team. Only the team gets us from 0 to 1. And then we look at everything else, whether they're going to get us back from 1 to 0. So it's only the team. Even in our internal team discussions, if someone tries to talk about the space or the competitive landscape or how competitive it has become, etc., we just neglect it. Let's first decide to invest into that founder, and then discuss whether that's a red flag, whether it's a market that we don't want to touch. Obviously, a lot of all of these things are the decisions made by the founder. So if the founder wants to go into a very red ocean competitive space, let's discuss about his personality as to why he or she actually chose that space, but not the space itself. So it's very founder driven. And then within that founder driven bucket, I think it falls into 2 categories. Category A is founder has a very unique know-how in this one specific field. They're one of the top few thousand people in the world in that field. And that unique knowledge asymmetry, they think that something's coming and they're the ones to catch it. And we underwrite that. Whether that's going to happen in 12 months, 5 years, God knows. But there's that unique positioning of that founder. Or their founder skills are super strong. Their iterative mindset, playing with all the different parts, all the different levers of the business is super strong. So some wind is gonna come to some location, but they're changing everything so fast that they're gonna be the one catching it. Again, it might happen in a year, it might happen in 5 years. So in that case, we're not betting on the unique positioning of the founder or the fact that they're one of the few thousand people in their field. They're not, but A, they're going to learn along the way. So the current ability and potential ability slope is going to be steeper there. And then B, they're iterating so fast that, you know,
it's execution speed.
Exactly.
Right? Yeah. So I've actually just completely argued against myself, because my argument was going to be like, a bit of capital constraint helps because it helps founders to not be more risk averse, but take more strategic bets rather than just kind of throw everything at the wall. Your argument is they're going to have to throw everything at the wall anyway, because, you know, the growth doesn't come from never comes from where you expect it, like I would argue, right? And therefore give them the balance sheet to be able to do that.
And otherwise you push them to short-term thinking.
Yeah.
Otherwise they have to survive a year from now.
Yeah.
They have to get to a certain MRR, which pushes them towards mediocrity, which pushes them to execute in an industry where they haven't found product market fit, but they're just
Just
being
to stay
thrown
alive.
KPIs
Yeah.
that they have to
Yeah.
abide by. Although they know they haven't found product market fit, they just have to keep going for 10 years
Yeah.
and then not have a venture outcome for anyone, actually.
Yeah, I get that, and I think that's the difference. That is actually very much the difference between the US mentality and the European mentality, which is the US it's trust the founder, they'll get there. In the UK, it's like trust the numbers, and in venture, the numbers should always surprise you. They should, they shouldn't be linear and they shouldn't be predictable, because the whole point is like you should be able to go from 0 to X like without realizing it. And to your point, when it happens in such a way that it should almost be unexpected. Because in fact, some of the best founders I've ever worked with, when they get to product market fit, it comes as a surprise. It's like, oh, we landed on the proposition that seemed to stick. It wasn't like we calculated that this was going to work. It was like we did this thing and shit, actually customers really get this, and now we're flying, right?
Our unicorn fell. It's a funny story, but before summer last year, they were at like a couple million ARR, like less than 2 million ARR actually, and they were raising an A, and we gave them a term sheet. We gave them 10 million at 100.
Yeah.
For a 75 million fund, it's huge. Like,
Yeah,
you
it's
don't
massive.
give 10 at 100. We couldn't win the deal, but we still participated in the round. But then we offered the founders a secondary. We're like, hey, I mean, anything can happen with the business, so why don't we buy some secondaries from you guys?
Yeah.
Not even at a discount, but at a premium,
Oh, really? Wow.
which we were fine with.
Oh.
And this was
You wanted into the deal, essentially.
we wanted even more
You
ownership.
wanted more
that we
ownership,
could get,
yeah.
yes. So midsummer, I was speaking with the founder. He was back in Turkey, and like we were chilling in our summer house. And back then, they just opened self-serve. Before that, they didn't have a self-serve platform. So every day, he was telling me the revenues that they're doing on a daily basis. And it was doubling, sometimes quadrupling, day by day.
Jesus.
Going from July till September, and then they became a unicorn a couple of months later.
So yeah, so it happened. It like happened before you knew it. You had a conviction that it could happen, which is why you wanted more ownership. As part of their materials, their decks, like were their financials anywhere near to their predicted financials anywhere near to the reality?
That's what I also hate about I think if you're predicting the outcomes of a business, then it stops being a venture capitalist.
Yeah, no, because what happens is you convince yourself that is the outcome.
Exactly. And then you backwards calculate it, which is worse.
Yeah.
I think a lot of the great businesses, they either shoot for 3x growth and they get 10x growth.
Yeah.
Or they shoot for 3x growth and they get 2x growth, and it's not that good.
Yeah.
In this case, no one has underwritten that type of a growth.
Yeah.
But the reason why we built conviction and gave that 10 million term sheet was because their customers, a lot of them were based out of Turkey. And I thought that the US VCs were underwriting it wrong. They were behaving as if these customers are just like mom and pop developer studios using it.
Sure.
Whereas these are like companies that do a couple $100 million of revenue with a couple hundred engineers.
Yeah.
So I thought that we were underwriting the customer base much better.
So they didn't know so they didn't understand the ICP.
Is what I think.
Yeah. Almost certainly, I would argue that, almost certainly it would have been like, well, it's Turkey. How big is that market? This is the reality. I mean, obviously I can't say that all US VCs think that Europe is a tiny market, but I think there is this sort of snobbishness in the US that Europe is this tiny market. Well, no, it's actually double the size of the US. It's not as coherent. It's not as joined up. But there are 600 million people in Europe, and Turkey has how large is the population?
80 million.
80 million, right? So it's bigger than the UK.
I think being a US company targeting Europe or Turkey is good.
Yeah.
They like it. Being a European company targeting Europe.
Yeah, that's what
you get all the stigma.
That's exactly it. So one final question before we round up with the last last couple of things. We talked about this, but not on this pod, but separately. You met a ton of UK-based LPs. You built some relationships, but you found conversion to be hard. Why do you think that is? As a non-UK GP, what are the real blockers to raising here? And is it track record? Is it geography, a bit like what we were just talking about, or just lack of cultural proximity? Or is it something, are UK LPs just a bit risk averse? I don't know.
So I think our track record is as good as it can be, because we have 28 companies in Fund 1, 3 unicorns. Fund 2 is doing super well. Both of the funds IRRs are I wouldn't want to put it. I wouldn't want to say it because I don't think it's legal, but
Sure.
they're great.
Yeah.
But I think it's because of two things. A, this is a very trust-based business.
Yeah.
Trust needs to be more than 8 out of 10.
Yeah.
And then even if your track record is 5 out of 10, you're good. People would give their money to you because it's hard-earned cash that they're giving to you for 10 years, 12 years, maybe 15 years, for God knows. And then to build trust in a location, not being from there, you have to spend a lot of time with a lot of people. It would take years, if not a decade, and I haven't done that. But doing it for a couple of years, I don't think I was able to build the credibility and trust as much as I wanted to. I don't think anyone can, by the way, because it has nothing to do with your track record.
Yeah.
Almost.
No, it is a human thing. It is about sitting. It is about having a drink. It is about going for dinner. It is about
being someone's neighbors, going to the same colleges, them knowing your wife, or your kid goes to the same school. Like you build, it's almost like a spider building a web, which I couldn't do yet. I hope I will, but I haven't done it yet. That's part one. Part two is mandate, because a lot of the family offices are actually more like asset allocators, where there's a family. And it's not a first, second, third gen family. It's more like a fifth to 10th gen family. So the actual wealth creation happened maybe 200 years ago, that's how far you are from the actual wealth creator. And then there's all these layers of people who get allocations into certain geographies and mandates. If you're not, if your geography is not part of their mandate, in a lot of the cases, Eastern Europe and Turkey is not in anyone's mandate. It's more like they have an allocation for Europe, and they're doing 10 investments in Europe. And why not do this one part of Europe, just one investment, because it would blend in well. That happens time to time, but it's very limited.
No, predominantly it's like, let's find 10 European investors, like
exactly.
that can go Europe wide.
And the moment you get a mandated investor, the moment there's, for whatever weird reason they have, they're mandated to invest into Eastern Europe or Turkey, conversion.
Yeah, through the roof, because there's presumably very, very few other asset managers that they can turn to, right? And so it's more okay. So it's a combination of relationship and mandate, right? Like, so you need to be able to build the network, for want of a better word, and be in the room and be in the conversations, and be the guy that basically they WhatsApp when they have a question about whatever, which. To your point, that is a time, that the only limit to that is how much time you can spend and do that. The mandate point, I think that's very, I think it's fair. It's annoying, but it's fair, because, there are some that haven't, like, for example, I'm sure there will be certainly family offices that won't look at gaming as an industry, for example, right? So if that is a core part of your portfolio, then that potentially throws them off as well. Yeah.
And weirdly, US endowment funds understand it better. I think US endowment funds look at us like a US fund, because when they look at a portfolio, it's 85% US domiciled companies. When they look at the revenue, it's also 80% US revenue. So they treat us like a US fund with this interesting thesis that they have never seen before. It's almost like investing into immigrant founders in the US, but from this geography, and then enabling them to build technology teams back at home. And then they understand it, that you go through their process.
Yes, there's a narrative that you got to construct around it.
Exactly. For them, we're too small, I feel like.
Sure.
With the UK or European family offices or fund of funds, we couldn't even get to that stage. They were always looking at as a Turkey fund. Even though we tried to explain that it's more nuanced than that, they would try to put you into that emerging market bucket. And now with an emerging market bucket, there are certain biases that come. It's a hyper-local business, local currency, how much is your currency risk, etc. And then they would put you in that Turkey bucket within that emerging market bucket, which is not what we are. And obviously, it's very low chance that you can convert someone like that.
It feels like you should go on more podcasts.
Dude, I would love to. No one invites me. It's only you. That's why.
Well, that's because, we are the premier venture capital podcast in the, I don't know what we are, but you should sign up if you haven't subscribed for sure. No, look, I mean, I think it is a messaging thing, right? Like, I think exactly as we just said, it is about getting your message out there. It is about getting people to understand that nuance, right? Because that nuance can't be necessarily communicated in it certainly can be communicated in like an hour-long conversation, but to get your foot in the door, you need to have already explained that nuance, right?
Yeah, it's also in startups. Because before product market fit comes the messaging market fit.
100%.
And when you nail it, you're like, oh, this messaging sticks. Then you build the product around it. Also, for a fund, I don't think we've found our messaging market fit yet.
We talked about it earlier, right?
We don't have it.
Yeah.
I'm trying to think what it could be, and it just doesn't stick. Hopefully we will, but I think once I can explain our thesis in 5 words,
Yeah.
it would make a big difference.
Yeah, I mean, I think it took me like 4 years to finally end up with, like, you know, for my business, Emerge One is a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. Like that, like, and obviously now I can say it like off by heart or whatever, but it took a lot of words to get back to that, right? And I'm sure we could probably even improve it further, and we may well, right? But like, to your point, coming up with an elevator pitch, especially, and I think in venture is quite tough, right? Because you aren't selling a product, you're selling a suite, you are going to invest by its very nature into suite. Unless you are very hyper, you're a generalist fund, as you said, unless you are a very hyper specialized fund, like your thesis, your elevator pitch can only be something along the lines of, we invest in the best talent in emerging Europe, which includes Turkey, Eastern Europe, and Dash, right? Like it's hard to distill it without keeping it quite generic. And I think that's possibly the challenge.
Exactly.
I will have a think about how to...
Let me know if you come up with anything. Because if you say you're a cybersecurity fund in Israel,
yeah,
people want exposure to that. There are mandates to be invested into that. It's very easy.
It's easy.
You don't even have to be a good fund. Yeah. Probably there are generalist funds that have better returns in cybersecurity than you are.
But it's just very specific and obvious.
Again, you put yourself in that one bucket, and that bucket needs to be filled by someone.
Yeah.
I'm not sure which bucket we're sitting at.
So it's interesting, again, a couple of conversations I've been having recently. There is this bifurcation happening at the moment. I mean, there's always been there, right? But I think in a world where AI is creating more hyper verticalized kind of niche businesses, specialist funds are coming up more and more. And therefore, generalist funds have to be even more generalist, right? Because they've got to pick up everything else. And where you sit on that spectrum can actually make or break, right? Because if you are not generalist enough, then you fit into too few buckets, but nothing specific enough. And I guess if you're over generalist, then you may end up just being nothing to anyone, right? Like you're just like, well, okay, if you're that generalist, then I might as well sit in a fund of funds and just allocate my cash across, you know, multiple managers. Look, I will have a think about it, because that's the sort of stuff I actually love, love figuring out. So look, we're going to wrap up, but before we do, what is one thing that you have a contrarian conviction about from any area of life, whether that's work, politics, socially, or at home?
I think anyone can become an entrepreneur. I think if you go back 5,000 years, everyone was an entrepreneur. I'm not saying everyone can become a startup entrepreneur. Yeah. So not everyone needs to try building $1 billion business. But to make a living for yourself and to have a good life, I think everyone has the skill set to do it, even by themselves. But then education, society, work life curbs that, where you end up thinking that you cannot.
I agree. I have said this many times before. I think entrepreneurship is one of the best ways to free yourself, right? We all have the ability. We all have one thing that we're probably really good at. Yes, you can build up skills in figuring out finance. You can build up skills in figuring out how to sell stuff and marketing, all this sort of stuff. But I think we've been sold this kind of lie of you should work for it. Like, and again, to your point, right? Like for thousands of years, that isn't what we did. And then 150 years ago, we all started working 9 to 5, and then factory shifts, and then 7 days a week, and then we created the weekend, and all of this sort of rubbish. And we outsourced essentially our entire lives to first corporations and then government, right? And that's crazy. Like, and not to get into the geeky tax realm of this, because that's just sad. But when I founded my business, I was like, oh, okay, so I can do this, and I can do that, and I can save that much, and okay, I'm only going to be paying this much tax based on these. Oh shit! Like that is, a tenth of what I would have to do if I would. So I can actually earn. I can at a gross level earn less, keep more in my pocket, live my life how I want to live it, and enjoy what I'm doing. Why isn't everyone doing this? And I don't really get why everyone doesn't do that.
People get used to having their downsides protected.
Yeah, 100%.
And then, you know, yeah.
It's risk mitigation.
It's addiction.
It's again, as I say, it's outsourcing agency to other people, right?
Yeah.
Like, yes, you got to do a few more things, but you know, hey, look, live your lives. This is you only have one. And one final question, so we can get to know the real you. What is something that moves you emotionally?
Passion makes me cry. It's funny, like when we're watching something with my wife, whenever there's something around passion, might be a sportsman doing something, a sportsman working out throughout her life and then accomplishing something. Might be a small thing, even, it would make me cry. But then anything that's actually emotional happening in a movie, I wouldn't care that much. But then, yeah, passion is what, you know, makes me move.
So
Seeing anyone passionate on anything.
So that could be a singer, an athlete, it could be a politician.
My colleague talking to me about a deal.
Wow.
Like, it moves me and that I crave it. So all around throughout the day, I'm looking for different signs of passion from different parts of people in the conversation so that I can pull that part. And then I can get the rope and see the end of where that passion line ends.
I'm not sure I'm going to regret this question, but how passionate has this podcast been for you?
It's been very passionate because you are really passionate about this, aren't you? I mean, even before we started recording, talking about the podcast gets you moved. I think it's one of the things that make you enjoy what you do even more than your actual daily work.
I'm not even sure. Like, for me, it's always been. It's not the podcast. It's the conversations within it, right? Like I think. And 100%, like I'm being slightly facetious and a bit tongue in cheek. I love doing this for sure. But the reason I love doing it is because I get to talk to really interesting people like yourself on a regular basis and talk about things that I actually really do enjoy talking about. And yes, to your point, like day to day, I mean, like, does anyone really want Like, I mean, I don't want to talk about being a CFO. I mean, I do a lot, but you know, it's hardly like the most interesting, sexy kind of thing.
By the way, that's when I decided to go into venture capital. Not even venture capital, but the angel investing. So I was doing construction. I was working on a construction site.
Yeah.
And I would be speaking to the people that I got the job from or people that I'm giving the job to.
And how they made their money and how they...
Exactly. Like, I'm not getting to an intellectual, curious enough of a conversation from any parts of the value chain.
Yeah.
And it's just then me, my podcast, and my book. So I have vivid memories of being in a construction site in the eastern side of Turkey, and I would be reading a Dostoevsky in the bathroom of the construction site.
Yeah.
Or I would be going up and down in the construction site in Istanbul with This Week in Startups by Jason Calacanis in my ears for like 6 hours, 8 hours nonstop. Yeah. Otherwise, I wasn't able to, get enough throughout the day. And if I couldn't get enough throughout the day, then I couldn't sleep.
Yeah.
So it had a, rollover effect to the next day as well.
I love that. I mean, I think, and by the way, I think actually the message that I take from that is, even if you are doing the most mundane thing, there are many opportunities where you can pursue the things that interest you. I think the mistake that so many of us make is we do the mundane thing, we complain about not doing the interesting thing, but then we don't take action to actually get involved, right? Like, so if you want to be an angel investor, write a 500 quid check or a 50 pound check or a 10 pound check on a crowdfunding start. Like, start somewhere, do something, listen to the podcast, read the book, whatever it is. And find your way, right? And okay, we're talking about investing, but it could be anything. Like, if you're a crocheter, go up and pick up a set of knitting needles, right?
And if your job is curious enough, intellectually stimulating, then your non-job daytime or nighttime, you're looking for calmness from your family, from your spouse, whoever. If not, then it becomes the opposite, where you're trying to find interesting things and curious things apart after your job, but then your job is 8 hours, 10 hours a day. I mean, there's not that much left.
Somewhat balanced, but I mean, I think the core thing that both you and I are probably saying is find passion. It doesn't have to be your job, but you can find it, right? So, Enis, as always, it's been absolutely amazing having you on the podcast. For the audience, where can they find you online? You on LinkedIn? You on Twitter? Where's the best place for them?
I'm really active on LinkedIn.
Yeah.
I'm trying to become even more active because I'm now posting once every 2 days. I'm going to turn it to almost every day, but shoot me a message on LinkedIn. I'm always inbox 0 on LinkedIn every single night before I go to sleep.
You're way better than I am.
I clear my emails. I clear my LinkedIn inbox.
I'm very bad with my LinkedIn messages, but amazing. Well, look, Enis, thank you so much for joining me. It's been an absolute pleasure having you back on the podcast. Really excited to see where things go with E2VC. And for the meantime, thank you again for joining me.
Well, thanks for having me.